Well, hey there. It is Friday, February 9th, and obviously because it's Friday, we're going to do a 4-minute Friday instead of a 3-minute Thursday. I'm Terry Sawchuk from Sawchuk Wealth, and I thought I would focus on a few charts today just to give you some perspective on where we are currently, where we've been, and where I think we might be going in the short term. So let's start with the big news. The S&P 500 just broke through to an all-time high, and we're now over the 5,000 threshold. And if you remember from a little while back, I told you that I thought we could not only get to higher than 4,800, but maybe a little bit higher than 5,000 before I think we see the market start to give something back. And here we are, right at 5,000. And I suspect that we're getting close to a top here. One of the things that I want to point out is that on this chart, this red line here and this green line, how the momentum is sort of going downward, but the price is going upward. And that's telling us that the market may be running out of momentum as it's starting to get really, really high here. The other thing, and I know this is not new, and I've said this pretty consistently lately, but I do want to point out that most of the gains in the S&P 500 have been coming from 4 stocks. It's Facebook, Microsoft, it's Nvidia, and it's Amazon. Okay, these are the 4 companies, and really more recently it's just been Facebook and Nvidia. And obviously that's all tied to AI. But one thing I want to point out, and I think this is really important, is even though we're hitting this 5,000 threshold, if you go back, we were at 4,800 at the end of 2021. So basically for a 2-year period, the S&P 500 made a 200-point increase on a 48 to 100 to 5,000 S&P. So it's really not very much at all. And all we've done is, gone way down and really recovered what we've lost and made a modest gain. So I guess I would point to the fact that for most of our clients, we held up really well in 2022. We didn't lose anywhere near as much as the market did as a whole. The S&P was down 28%. And in 2023, the S&P was up quite a bit, and we certainly didn't participate to a large degree in that for a lot of reasons. But if you look at over a 2-year period, I'd say we're pretty close to where we should be. And we've done it with a lot less risk. And I think that's important perspective because as we go forward, there's a few things to take a look at here. One is that on a 10-year treasury, we've started to creep back up. Okay, and that's important because generally speaking, the higher interest rates go, the more difficult it's going to be on the market. We had, it's called a change of character in the market off the bottom here on the 10-year treasury. So that means that it went from rates going down to now rates going up. Now, I don't know whether we're going to crest this 4.2% rate on the 10-year treasury, but if we do, then that signals another leg up and we probably get all the way to 4.4, and that's not going to be bullish for stocks. The other thing I would say is oil is creeping back up. It's now at 77, and that's a sign of inflation, and it's going to mean that likely the Fed's not going to be able to cut rates as soon as people think. That's also not bullish for stocks. So in spite of the recent highs, I would say the euphoria is a little bit overdone, and I expect we're getting pretty close to a high point here in the S&P 500.